To understand what is happening on Wall Street in 2025, you need to step back from the numbers and grasp the bigger picture. This is not just about gold as a metal or jewelry. This is about how some of the world's smartest financiers, people who manage billions of dollars, have suddenly changed their strategy. They are doing something that would have been unimaginable just a few years ago. They are buying gold en masse like never before. The transformation is so dramatic that major investment banks have quietly rewritten their entire playbooks, fundamentally altering how they advise clients on portfolio allocation and risk management. Let us start with a simple observation. If you walk into a bank or log into an investment platform, you will see something strange. Financial institutions that traditionally viewed gold as something archaic, a relic of the past that produces no dividends and generates no profit, are suddenly speaking about it as one of the most important assets. Major investment firms like JP Morgan, Goldman Sachs, and Morgan Stanley, which have access to the best analysts and the deepest understanding of markets, have revised their forecasts for gold upward multiple times in recent months. They are predicting prices that seemed fantastical just 2 years ago. Some of the most conservative voices in finance now suggest that gold could appreciate significantly over the coming years, a statement that would have been considered radical in previous decades. The shift in sentiment is not gradual or tentative, it is profound and decisive. High net worth investors, those who manage their own wealth with extreme caution, have nearly doubled their gold allocations in the past year alone. Pension funds that have spent generations following textbook allocation strategies have begun rebalancing their portfolios to include more precious metals. Even the most risk-averse investors, those typically comfortable with bonds and treasury securities, are now exploring gold as a legitimate component of their core holdings. This represents a seismic shift in how the financial world views this yellow metal. What changed? To answer this question, we need to understand one concept that is now circulating on Wall Street with unprecedented intensity. It is called the debasement trade. This is an ancient concept that has its roots in the deep history of human civilization. Centuries ago, when kings and princes wanted to create more money without having more gold in their treasuries, they did something relatively simple, though it had profound consequences. They took a coin that actually contained gold, removed a portion of that precious metal, and replaced it with cheaper alternatives like copper or nickel. The coin looked the same, weighed almost the same, and could be spent as before. Citizens received more coins in their transactions, but each individual coin was worth progressively less in real terms. Prices for goods would rise accordingly. This is debasement. It is one of the oldest economic tricks in human history, and its consequences have always been the same. Inflation, eroded purchasing power, and eventually, social and economic instability. Today, the world has done the same thing, but in a way that is far more complex, far more sophisticated, and almost entirely invisible to the vast majority of people. Instead of physically removing precious metal from coins, governments print paper money and create digital entries on computer systems. Instead of monarchs deciding how many coins to mint, modern central banks expand their balance sheets at unprecedented rates. Governments spend vastly more than they earn, running enormous deficits year after year. Central banks purchase government debt, effectively financing this spending by creating new money out of nothing. They expand their balance sheets, creating new capital that is actually backed by nothing tangible, nothing real, nothing that has intrinsic value. The result is identical to what happened in medieval times, just far less obvious and far harder for ordinary citizens to understand or track. The currencies of the world are quietly being debased. The purchasing power of a dollar, a euro, or any other fiat currency is slowly but inexorably eroding. When this happens, when the foundations of a monetary system become questionable, when people lose confidence in the value of paper money, one asset always rises in value: gold. It has no central bank that can print more of it. It cannot be created on a whim by a government decision. Its supply is limited by geology and physics, not by bureaucratic policy. It is money that cannot be printed, which is precisely why it becomes valuable when other forms of money lose their credibility. Financial professionals on Wall Street understand this better than almost anyone else on Earth. They see numbers that ordinary people never see. They have access to data that is proprietary, sophisticated, and deeply revealing about the true state of global finances. They see exactly how much money governments disperse every year and how this spending far exceeds what they collect in taxes. They observe how deficits explode, how the monetary base expands month after month, how central bank balance sheets grow to incomprehensible level. They understand the mathematics of compound interest and exponential growth better than anyone. They know there can be no other outcome except the gradual, relentless weakening of the value of money when you print it without limit. Gold is insurance against this inevitable outcome. It is an asset that does not depend on the promises of any government or bank, promises which history has shown are frequently broken or abandoned when circumstances change. Gold has existed for more than 5,000 years as something people want, something people value, when they cannot trust the system around them. During every major currency crisis in history, during every period of economic chaos, during every moment when governments have recklessly expanded their money supplies, gold has proven its worth. People in war zones want gold. People in countries experiencing hyperinflation want gold. People watching their savings evaporate want gold. It is the universal language of value when all other languages fail. But there is another very important factor that is spreading through all financial news at this moment. It is called protection from devaluation. In other words, central banks around the world are doing the same thing that makes gold attractive to private investors. China, Poland, India, Russia, and many other countries that previously accumulated American dollars as their primary reserve currency are now actively accumulating gold. They have been buying it steadily, methodically, in enormous quantities. China alone has been purchasing gold for 11 consecutive months at the time of writing. Poland has made shocking moves into gold. India's central bank continues to build reserves. This movement is not accidental or haphazard. It is a strategic choice made by the highest levels of government and finance. When countries accumulate gold, they are sending a clear signal to the world. They are saying that they no longer wish to rely entirely on the dollar. They are saying that they want to diversify away from currencies that can be printed at will by a foreign government. When the central banks of the world's major nations make this strategic shift, major investors watch very carefully and think deeply about it. If central banks around the world are doing this, they reason, then maybe we should too. Maybe this is not just a temporary trend, but a fundamental reshuffling of global financial architecture. This creates what is called a feedback loop or a cascade. The more people buy gold, the more countries accumulate gold, the more this action supports and increases the price. The rising price draws more attention, which draws more buyers, which raises the price further. The trend becomes self-reinforcing, and it feeds on itself. Institutional investors have also gained a new tool that makes gold easier to buy than ever before in human history. These are called exchange-traded funds, or ETFs, which are funds that track gold. With these funds, you can own gold without actually having to keep physical gold in your personal safe or vault. You simply buy a piece of paper, or more accurately, a digital entry in a computer system that represents your ownership rights to actual physical gold stored in secure facilities around the world. This has made it possible for millions of people and institutions to invest in gold easily and quickly, without the complications of storage, insurance, or authentication that come with physical possession. Pension funds can buy gold, university endowments can buy gold, insurance companies can buy gold. Ordinary people, through their retirement accounts, can buy gold, and they are doing so at extraordinary levels. In the first quarters of this year, investment flows into these gold tracking funds were the largest in many years, possibly in the history of these financial instruments. Hundreds of billions of dollars have flowed into physical gold holdings through these vehicles. This means that big money, institutional portfolios managing trillions of dollars, pension fund managers responsible for the retirements of millions of workers, hedge fund managers with the most sophisticated analytical tools at their disposal, all of them are simultaneously ordering their traders buy gold. When you see this kind of unanimous movement among the world's most sophisticated investors, it is worth paying attention. This is not retail speculation driven by social media hype. This is institutional capital, patient capital, capital that can afford to wait, making a deliberate and structured move. Moreover, there is something deeply troubling happening with traditional places to store money and preserve valuables. Bonds, which were once considered the holy grail of safe investments, the ultimate refuge for conservative investors, now look considerably less safe. The logic is simple and irrefutable. If a government needs money and its deficits are growing out of control, if it cannot cut spending and cannot raise taxes enough to balance its budget, it can always do one thing. It can print more money. When a government does this, when it creates money without creating corresponding value, when it floods the financial system with new currency, who do you think takes the hit? People who hold bonds denominated in those depreciating dollars or euros. People who have cash savings in bank accounts sitting in a currency that is being steadily diluted, people with fixed-rate contracts and long-term agreements that pay them a fixed number of currency units. All of that, everything expressed in currency, gets gradually eaten away by inflation and devaluation. Gold, on the other hand, does not depend on the promises or good intentions of any bureaucracy. Its value is not predicated on the belief that a government will act responsibly or maintain fiscal discipline. Its value is predicated on simple scarcity and universal desire. These two things are almost impossible to manipulate or destroy. A government cannot convince gold to stop being valuable. It cannot pass a law making gold less desirable. It cannot print gold. It cannot create supply out of nothing. The only way gold can be obtained is through mining it out of the earth, and this is an expensive, time-consuming, energy-intensive process that cannot be accelerated just because a government wishes it to be. There is yet another reason why the wolves of Wall Street are turning their eyes toward gold with such intensity, and it concerns most analysts and strategists. The world is now trying to think carefully about what will happen in the event of a serious crisis. These are the words you will hear constantly in meetings of large banks and investment funds: geopolitical risks, uncertainty, tensions, tail risks, systemic vulnerabilities. When the world remains genuinely unsure about what tomorrow will bring, when conflicts simmer in multiple regions, when supply chains remain fragile, when political tensions run high, investors look for places to direct their money to protect themselves. They seek assets that will retain value regardless of what happens. They seek assets that are not correlated with equities, bonds, or other traditional holdings. Gold is the classic place for this type of insurance investment. It is perhaps the only asset that people value equally, regardless of what language they speak or what country they live in. During currency crises in Argentina, people wanted gold. In Venezuela's economic collapse, people wanted gold. In the ongoing crisis in various emerging markets, people want gold. It is a universal value. It is a universal language. An ounce of gold is worth the same in Tokyo as it is in New York or London or Singapore. This universal nature of gold's value is one of its most important characteristics. It transcends political borders, cultural differences, and economic systems. It is money without a government. It is value without politics. What changed is fundamentally the perception of gold among major investors. Previously, for decades, they considered it useless from an investment perspective. Something that generates no income, produces no dividend, pays no interest. From a pure financial perspective, gold was viewed as a dead asset, something that just sits there and costs money to store. Why hold gold when you could hold a bond that pays interest, or a stock that pays dividends, or a treasury security that guarantees a return? This was the dominant logic. But the world has changed its mind, and the change is very real. When you can no longer trust traditional places to accumulate and preserve capital, when bonds may be wiped out by inflation, when banks may become fragile, when stock markets may crash, income and dividends become far less important than the preservation of capital itself. Gold does exactly that. It preserves your money from being consumed by inflation and devaluation. It preserves your purchasing power. It is a store of value that has worked for 5,000 years and has never failed to maintain its purchasing power over very long periods. This is not about making big money, becoming wealthy quick through speculation. This is about not losing what you already have, about protecting your family's wealth, about maintaining purchasing power across generations. The bigger picture includes something else that makes institutional investors think very carefully indeed. The composition of global reserves and the structure of the international monetary system are changing. In the past, the American dollar was absolute king. It was the undisputed reserve currency of the world. Every major country kept most of its reserves in dollars. Every major transaction was conducted in dollars. Every major government wanted to hold dollars. But the world understands now that if you rely too heavily on one currency, if you concentrate too much of your national wealth in one country's money, you are dependent on the decisions of one country and its central bank. You are vulnerable to that country's domestic politics, its inflation, its policy mistakes, and its strategic interests, which may not align with your own. This is a risk, and major nations are working to reduce this risk. Gold solves this problem elegantly. It is the only thing that does not depend on any country. No country can simply print more gold. It cannot be created by decree. Its supply is determined by geology and mining economics, not by policy. It is money that belongs to no one and therefore belongs to everyone equally. This quality makes it uniquely suited to be a reserve asset for a multipolar world. Of course, there are skeptics and doubters. Some of them point out that all of this enthusiasm for gold might form a bubble, a dangerous speculative excess that will eventually collapse. They say that people are buying gold with borrowed money, using leverage and margin, and that this could end very badly when the psychology shifts. They point to the volatility of gold prices and the fact that gold has experienced sharp sell-offs. They warn that recent pullbacks, like the dramatic 6% drop in a single day, could herald a broader crash. These are legitimate concerns worth considering, but what is happening on Wall Street is far more structured and deliberate than a speculative bubble. Big money rarely relies purely on speculation or on betting that greater fools will come along to bid prices higher. Professional investors make calculated bets based on solid data and fundamental analysis. And the data tells one consistent story from every angle. The world is printing paper money faster than ever before in history. Money supplies are expanding at rates not seen since wartime. Government deficits are growing. Central bank balance sheets are expanding. Geopolitical uncertainty is high and rising. Central banks around the world are accumulating gold systematically. All of these signals point in one direction. The fundamentals support higher gold prices for the indefinite future. What we are witnessing now is a major recalibration in how the world's smartest investors think about money and value and risk. Gold has transformed from being viewed as the end of the world option, the last line of defense for those who believe civilization will collapse, into something far more mainstream and important. It has become a core component of the modern investment portfolio, especially for people who understand that the global financial system faces genuine challenges and that things could go wrong. It is not about the extreme pessimists anymore. It is about prudent, professional investors who understand statistics and probability. The story of gold that is being told on Wall Street this year is a story about the signs of the times. It is a story about systemic risks rising throughout the world financial system, about investors being sophisticated and preparing accordingly for multiple scenarios. It is a story about how traditional ways of storing wealth no longer work the way they used to, how bonds no longer provide safety, how bank deposits face erosion from inflation. And it is a story about how one thing that was valuable 5,000 years ago during the reign of Egyptian pharaohs and ancient Chinese emperors remains valuable today, remains trusted today, regardless of how the world around it changes. Gold's value is rooted in something deeper than any particular monetary system or economic model. It is rooted in human nature, in the universal desire to preserve value, in the timeless fear of losing what you have, work to accumulate. That is why the wolves of Wall Street are buying gold with such determination and in such quantities. They understand something profound about the nature of value and trust that ordinary people sometimes forget or never fully learned. They understand that value is ultimately based on confidence and scarcity. When confidence in a system breaks down, real assets become more valuable. They understand the lessons of history, lessons written in the collapse of countless currencies and the erosion of countless fortunes. They understand that nothing is more certain than change, nothing more inevitable than the cycles of boom and bust. Nothing more important than protection against the unknown. Gold is the ultimate insurance policy in a world of increasing uncertainty, the ultimate hedge against the invisible forces eroding the value of paper money. As long as these fundamental conditions persist, as long as governments continue to spend more than they earn, as long as central banks continue to expand their money supplies, as long as the world remains uncertain about the future, the buying will likely continue. The wolves of Wall Street will remain vigilant, and their appetite for gold will not be easily satisfied.